All right, so we have a lot to do today. What we have is to cover two problem sets, 12 and 15, and then our sample final. All right. Now, all of these are on Moodle, of course. So when we're done with all of this, we'll actually be done with everything that we need to do for the semester. So that means that we will not actually need to meet on Monday. Monday was supposed to be our last class, but because we'll be done today, that means you'll get a bit of a miniature holiday. And so that gives you more time to work on the final exam, of course. So I don't think it's completely ready. I'll probably post it tomorrow or later on tonight. So whenever it gets posted, you'll have a week after that to do it. And I'm sure that'll be plenty of time. It's only those last few chapters, 12, 13, and 15. It's not comprehensive. So you don't have to worry about that. I think it was meant to be, was it tonight or tomorrow? I think. Let's see. Let me double check. Yeah, I think. All right. Well, let me look at my schedule. That was last week. Yeah, I think. I let's do tonight. Well, all right. I'll tell you what. Under the circumstances, you can have it on Friday as well. I mean, if you hand it in tonight, that's wonderful too. But let's just say you can have Friday as well, just because it's Friday, and so we're almost done with the semester, and so try to have it ready by tomorrow night, then, if not tonight. All right, that'll do. So let's. Oh yeah. So anyway, so we need 12. We need 15. And we need the final exam, a sample final rather. All right, so let's get them all open. This is 12. Let's get 15 going. Now, I didn't write one for 13 because it was too short. I just didn't think it was worth our while to have a separate problem set for that. That content might appear in the sample final, but it doesn't have its own separate problem set. And then one last thing, we need the sample final, and then we'll be all set. Very good. So yes, like I said, so when we're done with all three of these, we're completely done with the course. And so the only last detail, of course, would be the final exam. So this will be our last meeting, and I'll post the final exam tonight or tomorrow. And then let's say you should have them ready by maybe next Friday, the 14th. Yeah, that'll work because under normal conditions, we probably would have had our exam on the 13th anyway. So let's say that those will be due a week from tomorrow. Okay. All right. So let's go back to 12. Now, chapter 12 was our discussion about. Oh, this is it. Yes, exchange rates, and in particular, we're looking at the asset market approach to exchange rate determination. So we start out by asking ourselves the following question: what is one example of a long-run determinant of exchange rates? Now here, you notice how it only asks for one, and yet I've given you four. So on the actual test, if the question says, give me one, then you only have to give me one. But I wanted to have them all there for completeness sake. So you can see there's really four things that are considered to determine exchange rates in the long run. And those would be the domestic price level, productivity, consumer preferences, and finally trade barriers. Now, the law of one price basically says, in a nutshell, that a good should sell for the same price in all markets. Now, we saw that that's not necessarily true, especially when we're looking at foreign countries, but that's what it actually says. Now, according to this PPP theory, power parity, what is it that determines? All right, what is it that determines the exchange rate between two countries. In other words, what is the formula that we use with purchasing power parity to calculate the exchange rate between two countries? So E would be the exchange rate, and that is quoted as typically dollars per pound, but as long as it's domestic currency per unit or units of domestic currency, I just want to make that clear right up front. In other words, if this was, let's say, $2 per pound, that would be, hold on one second. Oh, that's okay. So in other words, the number we get out of this model will turn out to be so many units of the domestic currency per unit of the foreign currency. So if we're dealing with the dollar and the pound, for example, this will give us a dollar per pound exchange rate. So the P is the domestic price level, which in this case, if it was dollars per pound, then P would be the dollar or US price level, and P star would be the British price level. Now, why doesn't this model work? Well, there's a couple of reasons why it might not work. First of all, the existence of what we called non-traded goods and services. And that would mean, for example, goods that are either too inexpensive to be traded internationally, or where possibly they would be perishable. And you wouldn't, for example, expect to see Big Macs traded back and forth between the United States and England because they would spoil on the way over. So we have non-traded goods and services, and also trade barriers like tariffs and quotas can also interfere with free trade. And that would also explain why PPP does not hold. And it doesn't. It may have worked at one point in history, but right now it doesn't work very well at all because there's so many other factors besides prices that ultimately determine the strength of a currency. All right, now according to relative PPP or relative purchasing power parity, this is a version of PPP that actually holds fairly well because it is explained or expressed in terms of inflation rates. So in other words, it attributes the differences or changes in exchange rates to changes or differences in inflation rates. And that seems to work pretty well. The logic being that the higher a country's inflation rate, the weaker should be its currency. And that's exactly what happens. Now, here's our old friend, the asset approach. Remember, let me just pencil in what this model looks like just as a quick refresher. That's this one. Yeah, that's the one. That's the asset approach to exchange rate determination, where if you recall, the currencies that are trading in the foreign exchange markets are mainly seen by investors as another financial asset. In other words, the idea is that people are using them not so much to buy foreign goods and services, but mainly to buy foreign financial assets. They're not denying that people use them to buy foreign goods and services, but what they're saying is that for the most part, most of the trading in these markets is due to the acquisition of foreign financial assets like stocks and bonds or possibly bank accounts. So according to this model, and by the way, I just want to add one more piece here. This model implies the following formula for the equilibrium exchange rate. All right, hold on. It's not cooperating here. Let's move this up. All right, so in other words, this relationship implies that the equilibrium exchange rate equals the expected exchange rate divided by 1 plus the dollar rate of interest minus the British rate of interest. So with that in hand, it should be easy to tell what the impact would be of a change in any of these variables, even if it's just for purely algebraic reasons. But we should also understand the economic logic as well. All right, so here they're asking us What happens to the dollar if the UK rate of interest increases? Well, in terms of algebra, if you increase this British rate of interest, you're subtracting a larger number in the denominator. So therefore the denominator shrinks, and therefore the entire ratio increases, and that implies a weaker dollar. But in terms of economics, what this means is that the dollar should depreciate because the pound has become relatively more attractive to investors. So if I'm looking to invest my funds in the country with the highest rates of return, that means that I'm now more likely to buy British pounds than US dollars. And because of that, the dollar should get weaker because people are selling dollars to buy pounds. On the other hand, if the US rate of interest drops, it's actually the same thing because, again, the dollar has become relatively less attractive to investors than the pound. And once again, for the exact same logic or reasoning, the dollar should get weaker. Okay, people are less likely to buy US dollar assets and more likely to buy British pound assets, and that's going to put downward pressure on the dollar. Now, this part is about pessimism. Pessimism means that people are more worried about the state of the dollar. So in terms of the model, pessimism, let me just write this in here, more pessimism means this expectation term goes up. All right, so in terms of the variables, more pessimism means we expect a weaker dollar in the future. So that means this EE term in the numerator up here goes up. And if that numerator goes up, the entire ratio goes up. And so E, the spot exchange rate, goes up as well. And so because people are more worried about the dollar, in terms of economic logic, they'll sell dollars and buy other currencies, and the dollar will, of course, depreciate as a result. Okay, so again, you can work out all three of these with algebra, but also ideally you should understand the economic logic behind it. And remember, this model is based on the assumption, which I'll throw in here as well, is based on the premise that the main reason why investors hold foreign currencies is to invest in foreign financial assets. Therefore, if a country's interest rate rises, its currency will appreciate, and vice versa. If investors become pessimistic, or let's look at it a nicer way, optimistic, about a country's economic prospects, the currency will appreciate, and vice versa, of course. All right, so just a little rehash there of what this is all about, just so you can make sense out of these questions. All right, but there, of course, you don't have to do this part. You just were supposed to say, does the dollar depreciate or does the dollar appreciate? It doesn't actually ask for an explanation. Here, it just wants to know, depreciate or appreciate. Now, what is one factor that can cause investors to become more optimistic about the dollar? Well, again, I've listed 4 of them, but you really only needed 2, or 1 rather. So falling inflation is always helpful to any country's currency because the purchasing power of that currency is growing. Interest rates are helpful. They're actually a sign that the economy is growing. And so even though it's becoming more costly to borrow, typically rising interest rates are the result of stronger economic growth, which ties into number 3. And of course, just in general, if international tensions are falling, then people will become optimistic about any currency, including the dollar. Of course, the opposite, rising inflation, falling interest rates, et cetera, would cause us to become more pessimistic about the dollar. And then finally, we saw the Big Mac index. Does the PPP really hold in the real world? The answer is no, not according to this Big Mac index, which shows that it's not even close. Okay. Now, here's the asset model again. And this time we're going to do some calculations and some graphs. So for example, suppose we're told that the euro dollar rate of interest is 3%. All right, that would be this subscript dollar, of course, it means we're looking at the US rate. The euro dollar rate is 3%, euro sterling is 4%. And we expect the dollar pound exchange rate to be $1.50 in the future. So the question is, what is the equilibrium exchange rate? So here I've repeated the models, and you can see if you plug in the numbers, the equilibrium exchange rate with these data is 1.5152 per pound. And here's a nice drawing of that. I'll just move that up there because I'm running out of space. But you can see, remember, the US rate is the vertical curve. The return to the foreign currency is a downward sloping curve. And then where they cross, that's our equilibrium exchange rate. And down here, you can see we have the US rate of interest. So this is our initial equilibrium point. Now, obviously, something's going to change so we can see the impact. All right, so first, just remember, this formula is how we calculate the equilibrium exchange rate in this model. Once we plug in the numbers, that should be no problem. It'll tell us the equilibrium exchange rate. Now, here's what's happening. In part C, euro sterling rises to 5% from 4%. All right, so the British rate is going up. Now, we've already seen that should cause the dollar to get weaker. But what we want to do now is calculate the exact value of the new equilibrium exchange rate. So we're going to change this 4% to 5%. And we'll see what happens as a result. So as we predicted, by changing the euro sterling rate from 4 to 5%, the equilibrium exchange rate went up from 1.5152 to 1.5306, which implies a weaker dollar. And that graph looks like this. So the return to the foreign currency is increased as a result of this change. So this entire curve shifts to the right. And as we can see in the graph, we have a higher equilibrium exchange rate, which implies that the dollar has depreciated and the pound has appreciated. And again, it's because a higher UK rate of interest makes this the pound more attractive than the dollar. And so investors will switch from dollars to pounds. All right, so that's pretty straightforward. This is not a very complicated model, but it does a good job of explaining how and why exchange rates change so much in the short run and what is actually driving those changes. Now, for this example, we're looking at two different currencies. It's now the euro dollar and the euro Swiss franc. All right, now, so here's what we know. We're told that the euro dollar rate is 3%. The euro Swiss franc rate is 2%. And the expectation is that the Swiss franc, dollars per Swiss franc exchange rate will be 95 cents per Swiss franc in 1 year. So we plug in the numbers like we always do, and this is our equilibrium exchange rate between the dollar and the Swiss franc. We're expecting, we think, it should be around 94 cents to buy 1 Swiss franc. Okay. And the graph will be exactly the same as we had before, except that we've changed the currencies. It's now the dollar and the Swiss franc instead of the dollar and the pound, but the Swiss franc is still considered to be the foreign currency. Okay, and this is what the graph looks like, and it's exactly what you'd expect. Oops, no, we don't want that. Yeah, that's fine. Like, let's keep it right there. And of course, now something has to change. Let's see what it is this time. That something is that, let's see. Oh, okay. So the euro dollar rate drops. All right. So it was 3%. So we're going to assume that it drops to 2%. So the US rate is dropping from 3 to 2%. That clearly should make the dollar weaker because the investors will probably shift their funds out of the US and into Switzerland as a result. So let's plug these numbers into the equation, keeping in mind that this 3% is being replaced by 2%. And so what ends up happening is that the new equilibrium exchange rate is exactly 95 cents per Swiss franc, which represents a depreciation of the dollar compared to the original level of 94.059 cents. So I'm going to graph that now. And basically what's going to happen is this return to the Swiss franc curve will be shifting up. Well, actually, so no, sorry, not this time. The US dollar rate is shifting to the left. All right, in other words, let's take a look at it. Yeah, that's right. This time it had nothing to do with Switzerland. It was the US dollar rate that changed and caused this to happen. So now it's the US interest rate that's dropped from 3 to 2%. And at where the curves cross, we have the new weaker dollar, 95 cents per Swiss franc instead of 94.059. And as we said before, we would expect this to happen because now the dollar has become relatively less attractive to investors than the Swiss franc. All right, now I think there's another one here. Yes, this time it involves the US and the Swedish krona. Very interesting choice. So actually, you know what I'm going to do? I just realized I left off the question here. So let me go get it so that we can see it right in front of us. Whoops. There we go. That would be this third one. All right, I'll copy that into the solutions. Not that one. All right, here we go. So this time we have a euro dollar rate of 3%, euro krona is 1%. If investors expect the dollar Swedish krona exchange rate to be 15 cents, SEK is the abbreviation for the Swedish krona. What is the equilibrium exchange rate? Okay, so again, what do we know? The euro dollar rate is 3%. The euro kroner is 1%. And investors are seeing or expecting this exchange rate to be 15 cents per kroner in 1 year. All right, that's all we need to know to plug these numbers into the formula. And we end up with 14.706 US dollars per, or 0.14706 dollars per SEK. In other words, approximately 14.7 cents. And of course, we need to graph this. So let's take a look at that graph. And you'll see it's just like the same setup as all the other cases. All right, very good. Except it's a different foreign currency. And then in this case, what happens is, the expected dollar SEK exchange rate rises to 18 cents per krona. This means that the investors have become more pessimistic about the dollar because the future price of the kroner is expected to be 18 cents instead of 15 cents. All right, so we know already, logically, that that should cause a weaker dollar. All right, so let's see how that happens. So we plug in the numbers, and yes, the new exchange rate is higher than it was. It's moved all the way up to 17.647 cents per krona. Here's the new expectation. And so what the curve that will shift now is the return to the kroner. It will shift to the right, and you'll see that at the new intersection, you'll have a higher exchange rate and a weaker dollar. All right, let's see, where is this? All right, I think I can just about, let's see, ooh, does this fit? I don't know. They came in focused and they trying to squeeze it all into one sheet if I can. It just looks better. Defense allows, and that's a shot he'll make all night. And then one drops. 76ers lead by 15. And so he just walks us inside and extends this lead. An uncontested shot at the rim. You have to compete. Right, when I'm done here, it'll look beautiful. All right, here we go. One more. There it is. Okay, so the entire curve shifts to the right because we have a higher expectation for the future exchange rate, which implies we're more pessimistic about the dollar. Okay, so in other words, E going up implies that investors are more pessimistic about the dollar. And that's what happened here. And so you can see the entire curve shifts to the right because this term has gone up. All right, so then we shift to the right and we do in fact have a weaker dollar. So this framework is actually very useful for explaining what happens in these markets, in the short run at least, when people are treating currencies as investment assets. In the long run, the focus is more on the cost of goods and services. But in the short run, we're primarily focused, according to these models, on rates of return to these different currencies. And this is what's primarily driving their strength in the marketplace. I think that was the last question in chapter 12. Let's see, let me just double check. It kind of looks that way, hold on. Yes, that was it for that one. All right, good. So now we're ready for 15. 15 is a little different because it's more about, it's almost like a history chapter. It's more about different exchange rate regimes that we've seen throughout history. And of course, we spend a lot of time talking about their pros and cons, which is always relevant. It doesn't matter when these other systems were tried. What matters to us today is how do they work and how successful are they? All right, so that's why, even though it's really a lot of history, it's still directly relevant to our understanding of foreign exchange markets today. Because certain things never change. For example, fixed exchange rates always have the same advantages and disadvantages. What can change, though, is market conditions. For example, a lot of the theories that were developed in the 17th and 18th century were based on the assumption that everyone was on the gold standard. Now, of course, that's not the case. So some of these theories, like PPP, are less likely to be true. But anyway, let's take a look at 15. All right, this is, yeah, that's the other one. Okay, so what is one of the key features of the gold standard? Well, all right, again, I've put 3 of them there. You don't need all 3, but these are all very important. First of all, obviously, each country's money supply was tied to its gold holdings. Otherwise, it wouldn't be called the gold standard, would it? Number two, balance of payments, deficits, and surpluses were corrected more or less automatically through gold flows from the deficit countries to the surplus countries. So if you owed another country money, most likely you'd end up having to cover your deficits by paying gold to the country with which you had a deficit. So if that happened now, we'd owe China a lot of gold, wouldn't we? Yes, we would. And then, of course, we had very stable prices and exchange rates because prices couldn't change very much because, let's face it, the supply of gold changes very slowly. And then on top of that, exchange rates were tied to gold holdings in each country. And so they didn't change very often either. So it gave us a lot of stability, but at the expense of not really being able to carry out monetary policy. So again, if we had a deficit, most likely gold would flow out of the country to the countries that had a surplus and vice versa. So that would tend to happen automatically. All right, anyway, so which financial panic triggered the creation of the Federal Reserve System? The Panic of 1907. So just to tell you, just as a little interesting anecdote about that panic, there was no central bank. And so what happened was all the top financial people in the country, like JP Morgan, for example, they all got together and they came up with a plan in which they would guarantee investors that if their banks ran out of money, that they would cover their losses. In other words, they acted like their own type of deposit insurance. And people, in the case of JP Morgan, a lot of people held New York City bonds and they were worried that the city would default on those bonds. Morgan actually was able to guarantee the credit of New York City with his own personal fortune. That way, people were not reluctant to hold on to New York City bonds because they knew that if New York City ran out of money, they could get the money from JP Morgan. So the idea here is that this guy was so rich, they could personally guarantee the credit of New York City with his own money. And that shows you where he stood with respect to the rest of the country. But anyway, so that panic, when it ended, everyone realized, we can't have this anymore. It's the 20th century. We need a modern financial system. We need a central bank. And of course, then they were able to put it together, and it's opened its doors in 1913, and we've had it ever since. Now, the exchange rate system that fixed the currencies of Western Europe to the dollar right after World War II was Bretton Woods. And it was named after the town in which the delegates met to come to this agreement, Bretton Woods, New Hampshire. All right, that's where the name comes from. It's a small town in New Hampshire, and it was chosen because it was out in the middle of nowhere. They didn't want the media bothering them, so they could do their work and come to this agreement, which is a very complicated structure that they created without being bothered by anyone. So that's why they chose, among other reasons, Bretton Woods. Now, what organization was founded in the Bretton Woods Agreement to help countries experiencing balance of payments difficulties? That was the IMF, right, which is still there to this day. And one of their main jobs is to help bail out countries that are having problems with their balance of payments. But they do a lot more than that too. But it's a relief agency that's designed specifically for international financial problems. Now, name one country that's dollarized. The one we focused our attention on was Ecuador, although there have been others. But I would say Ecuador is the best case. And of course, we know that it's been highly successful. A country that used a currency board, that was Argentina, which sadly didn't get very far. After about 10 years, they had to abandon it. And of course, then the currency collapsed and they defaulted on their debts. But it did work fairly well for a while. What is one of the advantages of dollarization? It can reduce interest rates and inflation, as we saw in Ecuador. But one of the drawbacks is that it can eliminate the country's ability to conduct an independent monetary policy. And, obviously Ecuador has been very successful for the last 20 years, so it can't be that big of a problem. But that implies that they've been very careful managing their fiscal policy, which involves taxing and spending. If not, if they were constantly running up massive deficits, eventually the whole system would collapse. But because they're directly tied to the US, whether they like it or not. How many countries are using the euro as their common currency? In other words, they're members of this EMU. At the moment, there's 19, with a few others on the doorstep. There's a few others that may join in the next 2 or 3 years, but right now there are 19 members. And you might recall we mentioned that Hong Kong has a currency peg with the dollar. They've kept it at 7.8 Hong Kong dollars per US dollar for quite a few years now. And obviously it's been very successful because Hong Kong is one of the wealthiest countries in the world. Okay, now what is one of the good things? In other words, why is Hong Kong doing this? Well, fixed exchange rates can lead to more stable domestic prices, which is very helpful for international trade. It reduces or eliminates foreign exchange risk as well. So if I'm doing business in Hong Kong, I don't have to worry about exchange rate risk because I know that this exchange rate will not change. And that's what they want in Hong Kong. Most of their GDP comes from trade, so they'll do whatever it takes to encourage people to do business in Hong Kong. All right. Now, but what is one of the drawbacks? Well, then, of course, as we've seen before, this eliminates the possibility of having their own independent monetary policy. What is one good thing about belonging to a monetary union such as the EMU, which is, again, unofficially it's called the Eurozone. These are the countries that share the euro as their common currency. So, well, first of all, there's no need to exchange currencies among the members. We get rid of all the uncertainty about exchange rates, meaning the volatility has been eliminated. It's easier to integrate financial markets. In other words, it's easier, for example, for a French investor to buy German stocks and that type of thing. And then more fiscal discipline is imposed on members that tend to have inflationary domestic policies like Italy. On the other hand, we've seen that it hasn't done a whole lot of good in Greece. They haven't really been able to get their act together, and they do tend to have a lot more inflation than in other countries in the EMU. But maybe their inflation rate would have been even higher. We don't know, had they not joined. Okay. All right. Now, what about 15? What is a drawback to being in a monetary union like the EMU? Well, of course, they lose their independent monetary policy. And even their fiscal policy, like it's set up here, it tends to impose more discipline on its members. In other words, it's not as easy for you to run up enormous deficits as it would be if you were not part of the monetary union. So countries like Italy that have traditionally had a lot of inflation are finding that they have to be more fiscally prudent, let's say, than they otherwise would be because they belong to the EMU. Okay, well, that was it. Okay. So this one was all short answers. All right, so that just leaves one more thing, and that is our sample final, which of course is a mixture of everything. Nice, okay. So again, this is just based on 12, 13, and 15 only. It is definitely not comprehensive. All right, so let's get that out. And let's see, okay, there it is. Okay, at long last, the solutions of the sample final. So now some of these, of course, it can't be helped. Some of these overlap with the problem sets that we just looked at. That's okay. For example, here, what is an example of a long-run determinant of exchange rates? There are basically 4 of them. Now, this is the long run, when we're thinking more in terms of the attractiveness of a country's goods and services rather than the rates of return to those currencies. In the short run, we're focused on rates of return. In the long run, we're focused on acquiring foreign goods and services as cheaply as possible. So you notice these are all focused on things that make products more expensive or less expensive, like the price level, productivity, consumer preferences, trade barriers. None of these are really related to rates of return because these are long run factors. All right. Now, of course, like I said, we're going to see a few repeats here. The law of one price, again, simply says that a good should sell for the same price in all markets. Does that always hold? No. We can see that clearly with the Big Mac index. Now, here's our old friend PPP again. Suppose that we discover that the price level in the US is 150 and the price level in the UK is 100. That most likely would be based on the CPI in the US and the RPI in the UK. All right, so we know that P equals 150 and P star is 100. And since the PPP condition tells us that the exchange rate is simply the ratio of the two countries' price levels, that implies an exchange rate of $1.50 a pound. It's 100% based, as you can see, on the relationship between the two countries' price levels. Very good. Now, goods arbitrage, we mentioned this somewhere along the way. Goods arbitrage is very different than financial arbitrage because here we're buying relatively underpriced goods and selling relatively overpriced goods. So with financial arbitrage, instead of buying goods, you're buying financial securities like stocks and bonds and currencies. Here, you're looking at physical goods and possibly services. And we use the example of gold. We saw that what would happen if gold is priced differently in the US and the UK. People will buy it where it's cheaper, they'll sell it where it's more expensive, and they'll put the difference in their pockets. Non-traded goods and services, again, we had this earlier. These are goods that are either very inexpensive or perishable, where it does not make sense to trade them between countries. All right, so now this next question, we'll have to do some actual calculations for the relative PPP condition. And so let's see how that works again. So we're told that the exchange rate is currently $1.50 per pound. The US inflation rate is 1%, and the UK inflation rate is 2%. Now, the fact that the UK inflation rate is higher than the US inflation rate means that the dollar should get stronger against the pound. The question is how much? Well, according to this theory, the change should be reflective of the difference in the two exchange rates. So hold on, let me split the screen for a second here so you can see everything all at one shot. There it is. That's the formula. This is the relative PPP condition. Let me just make a note of that right here. And it just basically says that the percentage change in the exchange rate hold on one second. There we go. This is the percentage change in the exchange rate percentage change P. This is just the same thing as saying the domestic inflation rate. And this one is the foreign inflation rate because it just represents the percentage change in the price level, which is the same thing as the inflation rate. All right. So that difference is negative 1%. Now, what that means is that the exchange rate should drop by 1% over the coming year. Now, what would that do to the exchange rate? In other words, it was $1.50. What would it be after it falls by 1%? Well, that's easy to calculate. What you're going to do, here it is. So we have $1.50 minus 1% of $1.50, or $1.50 minus 1.5 cents. So we would expect that if nothing else changes, the exchange rate in 1 year should be $1.485 per pound, which implies a stronger dollar. And it implies by 1%, which is the difference in the inflation rates. Now, back to the asset market model, the exchange rate determination. If the UK rate of interest falls, then the pound will become relatively less attractive to investors. The dollar should appreciate because now people want to sell their pounds and buy more dollars. On the other hand, if the US rate of interest goes up, we have the same result because now the dollar is getting stronger because it is relatively more attractive to investors than the pound. Let me change that to the pound. All right, so either way, if the UK rate goes down or the US rate goes up, either way, the dollar will benefit from it. And now this is exactly the opposite of what we saw before. If the investors become more optimistic about the dollar, well, people will buy more dollars. They want to invest in the US economy, so people will buy more dollars, and therefore the dollar will get stronger. And that's all there is to it. So I think you'll agree this asset approach is actually quite straightforward. You may agree or disagree with it, but it makes a lot of sense. It does correspond to a lot of the behavior we see in the real world, at least in the short run. And here, once again, we've seen this before. How did a balance of payments surplus correct itself during the gold standard with gold inflows? All right, if we had a surplus, we would receive gold from countries with which who had a deficit with us. One advantage of dollarization, well, we already know that that's primarily stable prices. There it is. Stable prices and interest rates. One good thing about fixed exchange rates is that we can have more stable prices, which again, like in the case of Hong Kong, helps stimulate international trade with Hong Kong. In other words, they're able to trade more with other countries because they have a stable exchange rate. Now, which country recently left the European Union? Well, with all that controversy, it was England or the UK that dropped out of. Actually, the entire UK moved out. It wasn't just England. Let me change that because Scotland went along. Now, Scotland apparently didn't want to leave. And there's a lot of controversy about that. There was even talk about Scotland seceding from the United Kingdom and becoming a separate independent country, but it never happened. Part of the reason for that is because they're simply too poor to do something like that. They just could not survive on their own without the rest of the UK. But that was a sore point when Brexit was passed. The Scottish felt like that people weren't paying attention to what they wanted. Now, the common currency shared by 19 countries, of course, that's the euro. And again, one advantage of the gold standard, stable prices, stable exchange rates. All right, now we're ready for some problems. Now, there's a couple in here that we haven't been covering in these problem sets, but they are in chapter 12, rather, and that is the supply and demand framework that we use to determine how different factors affect the strength of the dollar. Okay, so this is a pure supply and demand framework, and they want to know here, what is the impact on the exchange rate between the dollar and the pound if US productivity rises? So this is a fairly complicated situation because at first, the supply of pounds, which by the way, I just want to mention here that wait a minute now. The graph got a little bit chewed up. Let's see if I can fix that. You know what? I'll tell you what. Let me just move the whole thing to the next page. So it's all together in one easy to see place. There we go. So just keep in mind that the quantity on that axis is pounds. Think of this exchange rate as the price of pounds in terms of dollars. And down here we have the quantity of pounds. So this behaves just like any other supply and demand framework we've ever seen. And so two things are actually happening here as a result of higher US productivity. Number one, now the supply of pounds is coming to the United States from Britain. In other words, the only way we can get our hands on pounds is if we earn them from the British. So when US productivity goes up, our products become relatively cheaper, and the British will buy more of our goods. Okay, so the UK buys more American goods or US goods. So the supply of dollars, not dollars, pounds, it increases. Now, having said that, though, because our prices are getting cheaper, the US, let's put it down here, the US buys fewer UK goods. Now, remember, for us to buy British goods, we have to buy pounds. So if we're buying fewer UK goods, that means the demand for pounds decreases. So the net effect of this is that the supply of pounds increases, and the demand for pounds decreases at the same time. That's what this graph is showing us. And the net effect, now, it turns out, see in the graph, we're going from 1 to 2 to 3. No matter how this works out, the dollar's getting stronger. Now, as far as the quantities go, it's hard to say where we end up without knowing the strength of these movements. In other words, it's possible that Q could go up or down. Without more information, we can't be sure, but we do know for sure that E drops from E1 to E3, and therefore the dollar appreciates. So higher productivity, and I mean, it totally makes sense that higher productivity should make the dollar get stronger because our goods and services are more attractive to foreign countries. So it's really just common sense. It's just a question of explaining how and why this is happening. All right, so now it's asking to draw this thing, so you have to be careful with it. Now, how about the second one? Oh, the preference for British goods by Americans decreases. All right, in other words, Americans, for some reason, are losing their taste for British goods. They don't want as many British goods as they used to. This one's different because the only thing that's changing is that because, again, we have to buy pounds to buy British goods, the demand for British goods decreases, or I should say UK goods decreases. So therefore, this means that the demand for pounds decreases. But not the supply. The supply is not changing. This is not affecting the desire of UK citizens to buy American goods. So only the demand curve shifts, and we end up with a stronger dollar, just like we did before. Okay, so US taste for UK goods decreases. Nice. All right. So again, the bottom line is the demand curve shifts to the left, and therefore the dollar gets stronger. So this one is a little bit more straightforward. I think you'll agree. All right. Now, guess what? We've got it looks like one more of these guys, or two more actually. They're pretty much the same. So let's just quickly go through these. So first we have a case where we have dollars and pounds. The US rate is 2, and the UK rate is 5. And the expected exchange rate is $1.50. So we plug these into this equation, and our equilibrium exchange rate is right here. Here's the graph. This one's hand drawn. It's not as pretty as the other ones, but it shows everything we need to know. And so what's going to happen is the euro sterling will drop from 5% to 4%. And as a result, you can imagine what's going to happen. The dollar will get stronger because the pound has become relatively less attractive than it was previously. So first thing we have to do is figure out the new equilibrium exchange rate and then show this on a new graph. All right, so let's do that. So yes, it's 153.06 now after changing or reducing the euro sterling rate. And you can see that in the graph, the curve that represents the return to pounds has shifted to the left. And we end up down here with a stronger dollar. Exactly as we expected. Okay, now in the next case, we have a similar setup. This time, what's going to change is the euro dollar rate. Okay, well, we kind of already know what that means. If the euro dollar rate drops, we'd certainly expect a weaker dollar. And that's exactly what we're going to see. So let's look at this one. So we start with our equation. Let's move this down here. And and what do we know? The US rate or euro dollar is 3. And euro sterling is 1. This time, the expected exchange rate is $1.60 per pound. All right, we plug in those numbers and we get an equilibrium exchange rate of 156.86, which you can see it right here. Again, kind of a clumsy drawing, but not too terrible. And then what's happening is that the euro dollar rate drops to 2, which we know will make the dollar get weaker. So how does that show itself on this graph? Well, we plug in the numbers and you can see down here, the new equilibrium exchange rate is 158.42 per pound, which clearly means a weaker dollar. And so how do we show that? Well, then the US rate has to shift to the left in order to show this. Okay. And when that happens, we'll see that there's a weaker dollar. All right, so let's take a look at the new, yeah, there it is. So the US dollar curve shifted to the left, and we do in fact have a weaker dollar, just as we expected. All right, there's no mystery here. The dollar's become relatively less attractive than the pound. All right, that is it for this sample final. So I will post these 3 today or tonight. And the sample final, the final exam, if it's not already there, I'll put it up later on today or tomorrow, because I think I'm still finishing it up. But either way, you'll have it for sure by Friday, and then you'll have a week to finish it, and then we are completely done. And so don't forget, then we will not be having a class on Monday because we're completely done. You'll be getting a little miniature vacation, which you can use maybe to work on your final exam. Who knows? But anyway, you look at it, you're getting some free time. Oh, yes, go ahead.
Do we still have time to submit midterm 2?
That's you can have till tomorrow for that one.
Okay.
And then the final can be the following Friday. Okay.
When you say till tomorrow, do you mean like at tonight at 11 or like at
No.
tomorrow?
I mean, when I say tomorrow, I mean tomorrow at midnight.
Okay, thank you.
Friday at midnight. Yes. Good question though. No. Next Thursday we're on final, is the start of the final exams. We were not going to meet on Thursday anyway. It's Monday that we're not going to meet. So in other words, you're getting a free day off on Monday. That's right. Thursday was supposed to be the start of the final exam week. So we were not going to have a class next Thursday anyway. It's just you're getting that one free day off. That's all. I hope you can put it to good use. All right. Anyone else have a question?
I actually do. So I did email you about my situation last week. I turned in the midterm early.
Oh,
so do you want me to resend it just in case like gets lost?
Yes.
Or
Yes.
Okay, I'll resend it then.
Just in case, because you never know when it might have wound up in my junk box. It happens all the time.
All right, so I'll resend it then.
Yeah, I think that's a good idea.
Sent it Tuesday, I believe.
All right, try it again. It doesn't matter. If I see them both, I'll just delete one of them.
Okay.
Anyone else? All right, well then I hope you have a good set of final exams, and you never know when we might bump into each other again, because obviously there are many different economic electives you could take, whether you're a major or not, and you never know what you might find interesting. And so this was a very intense course, but I think we learned a lot of very useful information, especially since as time goes by, the world will only do more and more trade, and there'll be more and more integration between financial markets and countries. And so this is extremely important and topical. And the more you understand what we did here, the more you'll understand what you read in the Wall Street Journal, let's say, or whatever else you're reading. And this can only be beneficial, especially if you end up in a career in business of some kind, where there's a lot of interaction with foreign countries. So anyway, so I guess we're done. So who knows, maybe we'll see each other again one of these days. All right, so see you soon.
Thank you so much.
Thank you, Professor.
You're
Good luck,
welcome.
everyone. Have a good day, everyone.
Okay, bye.
Yeah, you too.
You're welcome.
Bye, Professor.
Bye.